Thanks for joining this Property Tribes interview. Today is the 5th anniversary that the Bank of England announced that the base rate was going to go to 0.5%. So it really is a landmark day. And to discuss that, I'm joined by Stuart Law, who is a landlord and also, of course, CEO of Assetz. So Stuart, welcome. 5 years of interest rates at 0.5%. Can you believe it?
Yeah, with hindsight, yes. It was one of the possible outcomes. You know, the aggressive drop in rates when the Bank of England belatedly caught on to the problems in the economy and the banking system was so sudden and such a big drop that clearly it was going to be something that was going to be around for a while. And you know, as I've said to people for a long time, if the Bank of England thought the stock market was going to halve the next day, what would they do about it? Nothing. If they thought the property market was going to halve the next day, what would they do about it? Absolutely everything possible, because of its underpinning of the banking system and the whole economy and the wealth of the country. And you know what? I think that's what they did. Exactly that. Indeed.
And who would you say were the winners and the losers over the last 5 years of this low interest rate environment?
It depends on which. If we look backwards and look at the beginning of the cycle, the big losers were the shareholders in biggest terms, the shareholders of the banks. They lost out the most, and of course the previous bank management who lost out on some of their bonuses. No tear shed there, probably. More recently, in the middle of the cycle, we saw quite a lot of property owners and developers and so on stopped out of their positions by banks taking control of their sites and their properties. Mm-hmm. So they were the losers in the middle part of the cycle. Now, who's the losers? I suppose it's the people without enough cash to take advantage of what's now a rising market rather than a market that was steady and high yielding. We've now got moderate yields rather than high, but price growth as well, which is a fantastic mix. But if you haven't got cash, very hard to take advantage.
No, I totally agree. Let's just talk about what I call zombie landlords for a moment. Landlords that have only survived because of this low interest rate environment. And I think there is a significant number of them around. How could they have used this time to shore up their position and the remaining time that interest rates remain low? Because one of the obvious things to do is to pay down mortgage or credit card debt.
It is, yeah, for sure. And paying down the most expensive interest rate debt you've got is always the best strategy, the simplest strategy. But it's all about where they are. The most important thing they could have done, if they're zombie landlords and relatively short of cash, the most important thing they can have done is make sure their rents have risen in line with the market or even helped push the market up in their area. Which, of course, if you're the leading person trying to push up, you've had the chance to do it and have a slightly longer void in the recession because we've got very low mortgage costs for most people, because the majority of people ended up on trackers one way or the other, and trackers above 0.5% is not a lot, even with one or two banks' attempts to change that, as we've seen. So they should have been doing that, but probably not a lot else they could have done, apart from maybe beginning to dispose of their property now.
Mm-hmm. There are a lot of landlords selling, yeah.
There are, yeah, there's quite a few. You know, if they got locked in and decided they didn't want to be a landlord after all, because it wasn't just a one-way street on growth, then, yeah, some might belatedly be now taking opportunity to sell, just as, ironically, we enter the next big growth cycle, which is, you know, if you put a stake in the ground outside London, I would say was in some ways, last year, spring. But in other ways, the word recession hasn't been heard this year in terms of what I've heard people saying. And recovery is the word this year. So in some ways, for certainty, this Christmas just gone was the stake in the ground, and we're looking at the next cycle of growth of the country outside London. But I think there's one last important point to make about your question about zombie landlords. And it's our belief, and it has been for years, a very simple phrase: 3% is the new 5%. I've been saying it for years, and quite simply, we believe that base rates, when they do go back up, it'll be slow, and it will stop somewhere sensible, like 3% or so, for quite a period. And the reason we've always said this for the last few years is that They can't raise rates till the economy shows strong growth, which we're beginning to see now, and they'll wait until it's certain, in a year's time perhaps. And then, why would they raise it to 5%? If they very quickly move back to 5 base rate, we've got an awful lot of mortgages taken out in the recession, which have much bigger margin, profit margin for the banks. Now that's not good. If they raise bases back to 5%, they're going to carry a lot of people up into 7, 8, 9% mortgage rates. Now, given the Bank of England's remits, specifically mainly, keeping inflation under control, etc., we do not need to be raising base rates to 5% or greater to control inflation like in the old days, because the margin on top of base is much bigger nowadays. So we've seen this coming, and our forecast, our statement of 3 is the new 5%, is that 3 could be stable for a long time as a base rate, because the banks have got enough profit margin on that at a 5 or 6 payable interest rate to make good money and rebuild their balance sheets. So the Bank of England doesn't need to raise beyond about 3, we would suspect. Now, that's really good news for zombie landlords, because they're in old deals, most of them, and they're not going to touch. They're still going to be very cash positive at 3 plus their margin. And with rent growth as well through the recession, which has been pretty strong, I think they'll be in a very good place for many, many years to come. And by the time base goes back to 5, rents will be so far out there that I don't think it will ever matter. So my prediction is that zombie landlords never do have a problem, even when base rates rise again.
Very interesting to hear your views. In a nutshell, what advice are you giving Assetz clients and potential landlords of how to stay safe in this very now becoming competitive market? Still focus on cash flow, I guess.
It is. And to be fair, the last 5 years have been yield. But from this year onwards, and probably for the next few years, we've got yield and growth. And investors are definitely heading towards more capital growth requirements, without a doubt. And who wouldn't? If 5% house price growth on a 75% mortgage gives you 20% capital, great capital gain on your deposit, then who's going to ignore that in today's market? And to be fair, even relatively cautious people are looking at that and doing it. So I think keeping some cash back, and bearing in mind most buyers nowadays are relatively cash rich who are active, so keep cash back, make sure you don't take your eye off the ball on interest rates and on risk, try and fix your mortgage rates, and really always think today is not pure speculation. So if you're not cash positive, probably don't do it. And if you stick to that, it does cause a bit of a problem if you intend to invest in London, because you're going to find it very hard to be cash positive and have a mortgage on a cash flow basis. So you're either going to have to sacrifice the gearing effect by not having a mortgage and staying safe and having the modest yield in London, or take a risk and go pure speculation and be cash flow neutral or negative and hope for the growth. Whereas in cities like Manchester and all the other major cities around the country, you can have both. You can have a 4 or 5% net yield, comfortably covering your mortgage on a 50 to 75% basis, and have double to quadruple house price growth with a 50 to 75% mortgage. So there's a place for everybody, and debt remains a tactical weapon, but not a speculative weapon, we hope.
Okay, well, just to wind this up, Stuart, we mentioned the winners and losers. The losers really are the savers, and I think this is why there is an advent in interest in peer-to-peer lending, where companies like Assetz Capital are offering a much better return than traditional high street savings accounts.
Yeah, it's true, and I think it's a bit like the dot-com boom broke the retail high street, and we're seeing problems in that sector now in certain parts of it. In a similar way, banking had a stranglehold on lending, and what the recession has done is open the floodgates of access with government approval and FCA approval to get lending. We've seen today the announcement of the final regulatory regime for peer-to-peer lending, and we're delivering an average across our book for our lenders. Our lenders are earning 12.7% average secured loans, 62% average loan to value across the book. Not bad. Now, you don't get capital growth on a loan, but 12.7% secured, 62% is interesting good place to put your cash. And some people are using it to park cash, others are using it as a blended return alongside investment properties. It's got a place for most people, and vice versa. Landlords, developers are using our service to borrow as well if they have issues or they're looking for short-term bridging. So it's going to become very, very big in years to come. We've gone through the billion of lending in the UK on peer-to-peer, but you haven't seen anything yet. And when they open it up to ISA investments, ISAs have about 25 billion a year put into cash ISAs. When that lot starts deploying, and the rest of the 250 billion already deployed into cash ISAs starts getting access to peer-to-peer lending, I think we're going to see peer-to-peer become a major competitor for banks. And I think those lenders who've got good lending teams, experienced lending teams and good underwriting are going to become a major force in lending for the private investor market as well as businesses.
Fantastic. Well, interesting times ahead, Stuart, and thank you very much for joining us on this Property Tribes TV interview. We do value your input. Thank you.
Thank you.